Hey everyone, so today we're diving into a topic that's essential for beginner traders, and that is CFDs or contracts for difference. And in this video, I'm going to dive into what CFDs are, the benefits and risks of trading with CFDs, and then why some traders prefer CFDs over traditional assets. Remember that Forex trading is risky and most traders lose money. Anything discussed here is solely for educational purposes and should not be considered trading advice. Alright, so what exactly are CFDs? Well, CFDs stand for contracts for difference. Essentially, it's a contract between you and your broker. And rather than owning an asset like a stock or a commodity, you are speculating on its price movement. This means that you're basically only concerned with the price difference from when you open a position to when you close that position. Now, CFD trading is very different to buying stocks. When you buy a stock, you're essentially buying a portion of the company, and therefore you may get dividends or you may even get voting rights if that's part of your package. With CFD trading, on the other hand, you're not a shareholder. You simply bet on whether the price of that company will go up or go down. Now, I want to show you a very simple example of the difference between buying stocks and CFD trading. So imagine that you and a friend are playing a game where you want to guess the price of ice cream. Now, you're not actually buying the ice cream, you're betting on the price of ice cream. So you make a kind of special agreement with your friend, and this is called a CFD, or a contract for difference. So firstly, you make a prediction. You look at the price of ice cream today and guess if it will be higher or lower tomorrow. For example, today the ice cream costs $2 per cone. The deal is that you write down today's price and agree that whoever guessed right will get the difference in money from the other person. If the price goes up, your friend will give you that difference. If it goes down, you will give your friend the difference. So Fred thinks that the price will go up to $2.50 tomorrow, while Max thinks it will go down to $1.50 tomorrow. The next day, the price is $2.50. Fred was right. And since Fred's guess was closer, Max gives him the difference between the prices, 50 cents. So as you can see here, nobody actually owns ice cream, but Fred won based on the fact that the price had gone up by 50 cents. In real life, though, people speculate on assets such as gold, Forex, oil, or company shares, for example. And just like Fred and Max, they'll make agreements or contracts to get the difference if they speculated in the right direction. And these orders or bets are placed on a broker's trading platform. Now, I specifically want to talk about Forex trading and CFDs and how it's different from physically exchanging one currency for another. So, for example, if you change $1,000 for euros and the value of the euro rises compared to the dollar, you could exchange it back later and end up with more dollars than you started with. However, traditional currency exchange is typically used for travel or business purposes, and it doesn't allow for leverage or speculation on the price movements of those currencies. With Forex CFDs, it's very different. When you trade Forex, like for example the Euro USD, you speculate on its price movement without actually owning the underlying currency. Just like stocks or commodity CFDs, like I mentioned earlier, you will create a contract for difference with your broker, and you will speculate on whether one currency strengthens or weakens against the other. This setup basically allows traders to go long if they believe one currency like the euro will gain against the dollar, or go short if they expect it to weaken. And since it's a CFD, you can trade with leverage, which means you only have to put in a fraction of the total trade value as your deposit. This approach allows Forex traders to gain exposure to a large position size without putting in a huge amount of capital. But you must be aware that leverage increases your potential profits and it can increase your potential losses. It's a double-edged sword and should be used with caution. So why choose CFDs over traditional assets? Well, let's go over some key benefits. So firstly, it's much more accessible. This means that CFDs have a lower entry threshold. For example, some brokers allow you to open an account with just $1. Secondly, as I mentioned earlier, you gain access to leverage. For example, if a broker offers 20-to-1 leverage, you only need to put up 5% of the position's value. And as I mentioned earlier, while this can multiply your profits, it can also significantly multiply your losses. So use it wisely. And thirdly, CFDs allow you to go long or short, which means that you can profit whether the market is falling or rising. And this is great for fast-moving markets. And lastly, They're very convenient. You don't have to worry about physically owning the assets and then knowing what to do with them in terms of transportation and storage. You simply go onto the broker's platform and you speculate on the price difference of that asset. Now, while CFDs come with some great benefits, they also have some big risks attached too. First, you need to know that CFDs are volatile, and prices can change very quickly, which means that you can gain quite significantly in a short period of time, but you can also lose significantly too. Second, as I mentioned a couple of times in this video, the leverage risk. And what you've got to realize is that with a highly leveraged account, a small movement in the market can significantly affect your account. Then thirdly, there's the liquidity risk. In some cases, low liquidity can make it challenging to close a position at your desired price, especially during off-peak hours or trading less popular assets. And fourthly, something that I mentioned as a benefit earlier but can also be considered a risk is that you don't own the asset. And since you don't own the asset, you don't get the benefits of dividends, as I mentioned earlier, or bond interest, for example, as you do with traditional assets and owning those assets. However, to manage these risks, traders have a few different strategies, and I want to go through these very quickly. Firstly, you can set up stop loss orders. Stop loss orders help you to close out a position if the price hits a certain level and goes against you. This will prevent you from blowing your account or from making significant losses. Secondly, there's the opportunity for diversification. By spreading trades across different assets, you can reduce your risk. So if one asset underperforms, then other assets in your portfolio might help balance out this risk. However, you want to be very aware of diversifying your portfolio with correlated assets. Sometimes you can actually increase your risk unknowingly. And lastly, position sizing and low leverage. Many traders very wisely keep their position sizes very small relative to their accounts, and they have a rule like only risking 1 to 2% per trade and a maximum of 5% per trading day. They also keep their leverage low to give themselves room for market fluctuations. So in summary, CFDs are a great way to trade a large range of different assets with flexibility, leverage, and accessibility, but they also come with significant risks, including market volatility and leverage. So if you are considering trading with CFDs, please ensure that you have a solid risk management plan in place so that you can enjoy the potential upsides while minimizing the potential downsides. Thanks so much for watching. If you have any questions about CFDs or trading in general, please don't hesitate to contact us. Our website is fxscouts.com. And if you enjoyed this video, please don't hesitate to like and subscribe. See you in the next video.